All my content is also available in audio format on audia.io. Go to the website or download the app. All right, welcome in everybody. Hope you had a great weekend. A lot of stuff we have to go through today. So we got some news yesterday on Sunday that Tesla is going to be lowering the price in China for its offering. And a lot of people have been wondering, what kind of impact does this have to Tesla's profitability? Is there a demand problem? So on and so forth. But really what I'd like to do today is take the data we got from China and use that to extrapolate out what its impact is to Q4 and Q4 earnings. I think there's some variables in there that are being missed by especially the mainstream media, which we should be used to it by now, but that's okay. Anyway, let's get started right away. Let's get down to math and let's see what the numbers say. So let's do this cool effect again, because I'm so professional now. Wow. Okay. Dave Lee, Mr. Dave Lee, has been on the show before. Thank you very much, Dave, for putting this together for us here. So last night, 8:37 p.m. Central, we got a breakdown of what the price changes are going to be in China. So Model 3 standard range is going to go from 40 to 38 roughly. Performance from 50 to 48. Model Y standard range from 53 to 41, long range from 54 to 49, and then the performance Model Y 57 to 54, $55,000 roughly. So these are converted from the Chinese yuan to the US dollar. So in summary, if we take this and put it in a sort of chart for all of us to digest a little bit easier, the model range, the Model 3 standard range went down about 4%. The performance went down about 5%. Standard range Model Y went down about 5% as well. Long range Model Y has gone down about 9%, 9.4%, and then the performance about 4.8%. So the reason why we want to sort of break this out and look at each individual model and how much it went down is so that we can figure out what the effective change is to the entire Chinese market from a price decrease perspective. And so what I did for this is we have to come up with some sort of market share for each one of those brands, for each one of those models. What we can do then is we can take the price change from each one of those models, apply the market share that they effectively are going to have in China this quarter, rough estimations, but probably going to be pretty close. And then we can extrapolate out and see what the effective change is to not just China, but the entire global average selling price. So how is it going to impact revenues? And how is it going to impact the average selling price for the cars in quarter four, right? One would think that with a price decrease, you're going to have less revenues, right? Which is going to be the case, but what is that impact specifically? What does that actually mean? So with my assumptions, I assumed the standard range is going to have roughly a 30% market share, Model 3 performance about 10%. Model Y's standard range and longer range, I'm assuming they're going to be basically even at about 25% each, and then Model Y performance is going to be about 10%. So the thought process here is the performance vehicle models are going to have about 20% of the market share, which is reflected here. 10% plus 10% is 20%. And then the rest of the market in that country is going to be kind of split between Model Y and Model 3, but it's going to be 60% Model Y, 40% Model 3. And so that's how I came up with those market shares. To come up with the effective weight of the change for the entire Chinese fleet, all we have to do is take the percentage change right here and multiply it by that percentage of the market that vehicle is going to have, that type of vehicle. And then we're going to come out with an effective price change. And that's what we can use to figure out how revenues are impacted. So literally it's 3.8% times 30% is negative 1.1% weighted change for that model for the entire fleet. You do that for every single model, you add them up. And then the effective change becomes about 5.8% less than the previous prices, which are going to apply to quarter three. So for the China prices, we're going to expect quarter four on the whole to be roughly 5.8% less than Q3, okay? So what does that mean for the actual revenue numbers, right? Because we need to extrapolate this out and take it within the context of Tesla's total earnings, especially from the auto side. So this piece right here, we took from the quarter three release that just came out last week. So this is basically reiterated again by Tesla, but they gave us some rough, not really rough, but exact estimations of where they think their production is, their capacity is from a factory perspective. So here's a breakdown. A lot of people are familiar with it. So if we take that yearly number and we extrapolate that to the weekly number, we can take the yearly divided by essentially 50 weeks, because usually these factors have about 2 weeks off each of the year, maybe a little bit more, but let's just assume 50. Then we come up with a weekly number and a quarterly number. So based on that slide, if we just take the lower range, so if we just don't even say the greater than 750, just the exact 750, 250, and so on, then Fremont has about 650,000 yearly capacity, Shanghai about 750,000, and both Berlin and Texas about 250,000. And then you can see the weekly and quarterly extrapolated figures from that. Weekly, again, is divided by 50 for the yearly, and then quarterly is just a weekly times 13, because there's roughly 13 weeks in each quarter. So you can see that the quarterly production rate is roughly almost 500,000 vehicles, but we're probably going to be under that a little bit, right? Because Berlin and Texas are still ramping, right? So even though they might have an installed capacity of 250,000 cars per year, it doesn't necessarily mean that they have all the pieces in place to be able to get to that level. Those factories are ramping, so we have to account for that somehow, right? Excuse me. I have like asthma this morning. I don't know if you can hear the wheezing. It's so weird. Anyway, so some of the data sets we can use to figure that out. There was a report from Shanghai from September 19th and from Reuters, where they stated that Tesla completed a project to expand production capacity at the Shanghai plant. And then Tesla will test the production lines between 19th and the 30th. So theoretically, they're actively testing and pumping cars through there. But really, the last line is the important thing here, that Tesla is looking to reach a target of producing around 22,000 units of Model 3 and Model Y per week at the Shanghai plant. If we go to the slide before, you can see that Shanghai, based on that slide, is about 15,000. Which is a lot less than 22,000, right? Extrapolate that out for the year. However, we can't give them credit for that whole ramp for that quarter, because part of that quarter is going to be at the 15,000 and part of it's going to be theoretically at the 22,000, right? Based on this report. So here's what I did. Here's an assumption of that I took to try and mold Shanghai, Berlin, and Texas to what the likeliest weekly output is for Q4. So Fremont, I kept at 13,000. I don't think there's going to be any change there. But Shanghai, I'm going to assume about 18,000 cars per week instead of 15,000 because of that ramp that's happening there. And then in Berlin and Texas, I'm assuming about 3,000 total weekly average production for Q4, and Texas about 2,600. So on the quarterly call, we learned that Texas has hit 2,000 cars per week previously, and they're looking to get an extrapolated 2,600 cars per week to basically hit a daily goal, which times 7 gets you to weekly of the 2,600. But I'm assuming that for the rest of the quarter, they're going to be able to do that plus then some, right? Because they have 3 months to ramp. So that's how I came up with that 2,600 number. And then Berlin, we know, is a little bit ahead. So that's why I pegged them at 3,000. We know that they've hit 2,000 multiple times already. So I just realized I'm blocking the quarterly. This says quarterly down here. Apologies. Anyway, you add up the quarterly numbers based on these weekly extrapolations. We come up with about 475,000 cars likely to be produced this quarter in Q4. So we also know from the call that Zach, the CFO, stated that this delivery wave thing is being unwound, which means that we're still going to see cars in transit exiting the quarters from the cars that are produced. So in Q3, if you remember, if you're familiar with the Tesla story, you know that Tesla produced about 360,000 cars roughly, but they delivered 340,000 cars roughly. So they had about 20,000 cars in transit. I'm assuming that for Q4, the same thing happens again at about 25,000 cars, which I think is reasonable based on Zach's guidance. So the deliveries for the quarter are going to be about 450,000, but that's still quite a big number because versus Q3, they delivered 340,000. Q4, they're going to deliver potentially 100,000 cars more, right? So we'll use 450,000 as our baseline for what Q4 is likely to be from a deliveries perspective. And since we looked at that graph, and I'll go back twice here, Shanghai is going to be roughly 18,000 cars or 234,000 cars per quarter, which is roughly 50% or half of the total production for that quarter. China's going to do about 50% of that that quarter's production. So, and a lot of those are more than likely going to go local. Okay, so I'm going to take a very big assumption here, and I'm going to assume that 50%. And I'm doing this to try and make this model as conservative as possible. right? 50% of the cars manufactured in China, manufactured globally by Tesla, will go to China. 50%. And so 50% of those vehicles are going to take that price decrease that we talked about effectively, right? Because they're being sold to China. China's having a price decrease, boom, 50%. Not to mention that we're already like a few weeks into the quarter, right? So I'm taking a very conservative approach here, but let's use those numbers to give us a guiding light towards what the fourth quarter is going to look like. China is going to be minus 4.8%. And since we haven't seen any price decreases and they're very unlikely to happen for the rest of the quarter for the rest of the world, we know that the rest of the world is at 0% price change. So China is down 5.8%. The rest of the world is at 0. So how do we come up with an effective price change? Pretty simple. 50% of the total cars times essentially negative 4.8, which is the percentage. It shouldn't really be times. It should be, I already messed up on my slide. Think of it as 50% at less than 5.8% plus 50% at the same exact rate as they were before, because the price change didn't happen. The effective change for the entire global fleet from an average selling price perspective is going to be roughly 2.9%. A different way of doing this is by actually extrapolating out the ASPs out and using those numbers that we used before. So if Q3 auto revenues was 18.7%, which we can draw from the quarterly earnings report, and we know that in quarter three, Tesla delivered roughly 344,000 cars, the effective selling price for that quarter for those cars is roughly $54,364 per car for that quarter. So about $54,364. So we can do the same exact math that we did before. The $54,364 is going to be 5.8% less for half the fleet, because half the fleet is going to be sold in China for the quarter. The other 50% is going to be the same, right? Because again, it's going to the rest of the world, and the rest of the world hasn't had any price increases. So take the average selling price of 54,000 roughly times half times 1, which is effectively saying it's going to be at the same rate, plus the average selling price of 54,000 times half, 0.5, times 0.942, which is that 5.8% reduction. And if we do that math, it gives us a quarterly Q4 average selling price of $52,791, which if you compare it to Q3, the $54,364, again, that's effectively a 2.9% change in price. That's lower for the entire fleet. So China is down 5.8%, but because half the fleet is still at the same price, the effective fleet is down 2.9%. So now that we have revenues in mind and we understand how that's going to sort of play out for Q4 roughly, let's move on to COGS. So COGS, cost of goods sold, we know in Q2 we did about 10,000, Q3, and in Q3 we did about $10 billion in COGS in Q2, and 13.5 roughly billion dollars in Q3. And we delivered in Q2 about 54,000 cars, and in Q3 we delivered about 343,000 cars. So the average costs for those cars for those quarters in Q2 was about 41,000 per car, and in Q3 was about 39,000 per car. However, the very important thing here is that for the entire fleet, the COGS went down by about 5%. So the big takeaway here is that into Q4, we're going to lower the revenues essentially by 2.9%, but our COGS, our cost could go lower than the price, right? Which creates this increasing gap between revenue and costs, which gives you more margin. So the question becomes, is it likely for this 5% decrease from Q2 to Q3 to continue? And in my opinion, that's the case. And this is why. We have Berlin and Austin still ramping into the quarter, which is going to allow Tesla to take advantage of additional efficiencies and lower costs per car. We also have those Shanghai line improvements that we talked about from the Reuters article, which again is going to do effectively the same thing, but in Shanghai, which is already the most profitable factory for Tesla. We also have deflation in the supply chain that's continuing to happen. Last quarter, on the call, we got some guidance that they've sort of reached peak inflation in their channel, they believe, and they believe that they're going to start seeing lowering prices in the supply chain. as well as lowered Forex impact. If you look at the different studies that have been done recently, it looks like the last quarter, the Forex is the Forex exchange impact. Basically, the US dollar versus every other currency, those impacts are going to lessen into this quarter because the brunt of it has already happened. So Q4 is going to have less of an impact versus Q3 for that. So based on these variables, I do believe that the continuation of this 5% decrease in COGS is very, very likely in Q4. Some could even argue it could be bigger because of how much efficiency you gain from really going into big scale, because you're effectively using the same labor and the same cars, but you're pumping out the a bigger number of cars with the same number of folks and really machinery that you have. So that 5% theoretically could be conservative, which means that our quarter four average cost, call it, which is taking that Q3 minus the 5%, is going to be roughly $37,210. Okay, follow so far? So if we take the Q4 ASP that we came up with, which is that effective 2.9% reduction, versus the Q4 average costs, which is about $37,000, which we just came up with, the fourth quarter auto margins are actually going to go up versus Q3 because of that reduction in cost that's going to be greater than the reduction in price. All right. So Q4 auto GMs 29.5% versus Q3 of 27.9% effectively. When we take the total costs divided by the deliveries, that's how we came up with that number. Okay. So let's summarize. Let's summarize of what's going on, what we talk about so far. Total ASPs are probably going to go down by 3%. We're not taking into account any price increases that have been pushed into the channel or anything else, a higher uptake of full self-driving, a higher uptake of these software as a services that Tesla can offer. This is meant to be a conservative model as it stands right now. The ASPs are down 2.9%. The cost of goods sold are down 5%, which is a bigger gap. It's going to create that bigger gap. Our deliveries are going to be up 31%, so we're comparing the 340,000 roughly versus the 450,000 that Tesla's likely to do this quarter. And then our gross margins are going to be up 5.8% or 163 basis points, which again is just the difference between the 29.5 and the 27.9. So that's a summary. So on the call, we got guidance. Q4 will be epic. Q4 will be epic. Okay. That's probably why. This is probably why. So let's put it actually to numbers. What does it mean? So I took a consolidated version of the P&L from Tesla's earnings. So basically profit and loss, a form that Tesla has on their website where you can go in and check and see how many sales they had, how many costs they had. But this is sort of a consolidated version where I removed some lines and I added up some lines, okay? So in Q3, let's take Q3, which is the middle column right here, Q3. You can see the auto and revenue. So total auto is just the auto division. Total revenue is the total revenue from the business, including energy and services and so on. You also have the COGS, the gross profit, the operating expense, so on and so forth. But the key thing to really think about here is that these auto sales and the revenue sales here assume what we just talked about in this slide about the selling price and the cost of goods sold and an increase in energy as well, where the profit from that line is going to be about the same. So it's not really going to influence the margin too much, maybe like by 0.1%, maybe less. But it's a very, minimal impact, especially if you compare it to the rest of the auto. So the key thing here to compare is not only are our revenues going up by about $5 billion for the quarter, which again, for the total revenues would be the same. The COGS, you're also going to go up by about $3 billion, but it's less than the revenues. So we're going up in the revenues by $5 billion and less in the cost by about $2 billion. If we assume that the total operating expense is going to be roughly the same, a little bit higher because of more vehicles and so on and so forth, and then we assume a similar tax rate for the earnings and so on and so forth, we're going to go from net income to shareholders, which is basically the number that's most important here. How much money has the company created in the quarter or made in the quarter? We're going to go from about $3.3 billion in the quarter to 4.9 billion, effectively $5 billion generated in the quarter, which if you extrapolate out to a yearly basis, it's $20 billion in cash basically generated from profits from the business. From an adjusted EPS, that's the $1.05 for Q3, probably $1.52 for Q4. However, this $4.9 billion number is really the big take home here. So Tesla's going to be able to generate, look at how professional I am. Tesla's going to be able to generate roughly $5 billion in a quarter, which is going to be about $20 billion per year in this quarter. And then what is going to be the continuation into the future, right? But let's just take that number. Let's take that $20 billion number that they're going to generate yearly. That $19.8 billion net income per year. Again, just 4.9 times 4 is 19.8. Today, Tesla's market cap is roughly $640 billion right now as of this creation of the video. So 10:24, it's Monday, about 10:30 a.m. Central is when I recorded this video. Maybe a little bit later now because I was a little late getting to it. It's closer to 11:30, but that's okay. 640 billion is the market cap. If you take the market cap of the company and you divide it by the annualized earnings that Tesla is going to earn in Q4, the effective price to earnings ratio for the company is going to be 32 price to earnings, a 32 price to earnings ratio. So then the question becomes, if you think about Tesla and its growth potentials and how much money they're going to generate next year, and the fact that the Cybertruck is launching, and the fact that Shanghai is going to go from 18,000 cars per week to 22,000 cars per week, and the fact that Berlin right now and Austin are probably running at about half of a quarter, especially in Austin, of what they're supposed to be doing for the whole thing, right? If Austin's going to get to 1 million cars, and right now they're shipping 250,000 cars, supposedly going to be able to produce 250,000 cars in the coming quarter or two, you're still 1/4 of the way there. So you're half of 1/4 of the way there. Berlin's probably closer to 30 to 40% of the way there. And then we're not even talking about this cheaper $30,000 car. We're not talking about full self-driving, right? So I'm not going to tell you how to trade. None of this is financial advice. But really, for me, this is really the take-home story from this fourth quarter, is that within all the noise of Tesla decreasing prices in China and quote-unquote demand problems or so on and so forth, the reality is that Tesla has moved from being a company that's trading at insane quote-unquote price-to-earnings levels to just 32, right? So what are the other companies that are trading at that level, and how does Tesla fit within that context? I'm going to let you decide what you think on that, okay? But I hope this was helpful. I hope this sort of paints a picture for you on what to expect for Q4. I'm probably going to be wrong, to be completely honest, but I do think this is a good place to start to really try and extrapolate out what does the rest of the year look like and what does the upcoming quarters potentially look like as well. For me, again, this is the take-home slide. This is the one that really speaks to me. So that Tesla's trading at 32 price to earnings. This is roughly what Apple levels on a bull market. And Apple is like a fully integrated, fully developed company. Maybe not, maybe a little bit more, but it's 32. It's not that much, right? It's not that much. But you decide. You decide what you want to do. Thank you. Thank you for stopping in. If you enjoyed the content, hit like, subscribe. I just introduced merch as well. So if you want to support the channel through there, I have a link to the merch store in the description. And then I also have a Patreon, or you can join me right here on YouTube. And I would really appreciate the support. Not required, but always appreciate it. So thank you guys very much. I love you. Mwah. Have a great day. Take it easy. Bye-bye.